pretty upbeat, but when you take a look at how unemployment is rising and we have private consumption weakening, not to mention the stress in the banking sector, why should you be buying into Indian equities?
So yeah, if you're a momentum player, it doesn't look like a great time. But if you're a fundamental hopeful, like many of us are, I think there are pockets of great value that can be looked at. Overall valuations might be moderate, but certainly in deep value areas, you can find some good investment opportunities. We don't think the recovery might be V-shaped, but we think that for investors looking at 3 to 5 year time horizon, this could be as good a time as ever over the next 6 months to look at some picks.
You talked about how value can be had. Where do you see value? Which industries in particular? How do you play this?
So if you look at the last 18 months or so, in fact, from the high of Jan 18, the Indian markets really have been very, very divergent. So while the headline, the Nifty and the Sensex are up almost 10%, the small caps, as an example, are down 39%. So you have got a divergence of almost 40–50% across the broader market, which means that really the high quality, stable sectors, some of the big names have really delivered the growth that we see, and where investors have rightfully so, come in and made money. But then there's a very large swath of cyclical stocks, mid and small caps, which are beaten down to historic low levels. Now, some of these would benefit from any economic recovery that you might expect over the next 3 to 5 years. So that, to us, is a theme that investors could look at.
Vishal, that's it, isn't it? Do we get an economic recovery? Because it does seem that we've got a lot of pressure there at the moment, as Linda was alluding to at the start of the interview. But tell me, what at the moment is going wrong with the Indian economy?
That's a large question, but I'll try and summarize. I think, clearly there is manufacturing slowdown, which we are contending with. On top of that, there is a credit market which seems to be displaced, clearly a lack of trust among lenders. And the third is the sentiment, especially on consumer demand, seems to be quite weak. So combined, I think these are all showing up in many of the numbers that we track.
Okay, and does the Reserve Bank have the mandate to be able to do anything about it? They can ease monetary policy as they have been and continue doing that, but is it enough? What about the infrastructure programs that have been promised by Mr. Modi's government?
I think the RBI really has taken a bit of a break from the past in using all the tools at its disposal. So firstly, rates have been cut, as we've all seen. Second, liquidity, which was one part of the missing action over about 12 months back, has been now made abundant. So that's a policy tool that we really like. And the third, and importantly, guidance to the market has been very clear. So, if you look at a surplus liquidity position for some time with an RBI that's willing to cut rates if it needs to get back some semblance of growth, then we think that transmission will eventually take place. So I think all that could be done by the RBI is getting done now.
You talk about the RBI. It's already cut rate at 135 basis points, and you indicated that it still has its powder dry. Is there any policy tool that has yet to be tapped if it really needs to overcome a macroeconomic shock?
So I think a lot of the action is now shifting to the fiscal side with some of the policy measures that the government has recently taken. So just to get some amount of demand back and help companies' bottom lines, I think the last rate cut, which makes India so competitive with respect to most emerging markets, including those in Southeast Asia, is a significant step. So right off the bat, for the next few quarters, you can expect almost 8% EPS growth in most companies' bottom lines, which is significant, which of course helps you either defray debt or get investment back on track. For new companies coming in, we're now at 17% tax rates, which is among, again, the lowest in the entire zone. So it encourages manufacturing activity. So I think on the fiscal side, some pretty large steps have recently been taken. We think it will play out over the next 12 months.
How are you viewing the banking sector? Because we had the economics Nobel winner, Abhijit Banerjee, saying that it is in severe crisis, his own words, and he says what the government needs to do is divest its stake in state-owned banks to below 51% to make it more competitive.
So on the credit side, clearly there's been a series of mishaps, in a sense, if I can call it that. Maybe, start off the IBC, which did not allow banks to lend, the NBFCs stepping in, and now you have a bit of a trust deficit as well, started or triggered off from the ILFS default. But having said that, I think, some part of this is just the natural pain, but eventually it has to be growth that gets you back. So I think we're all looking forward to some amount of demand and therefore growth coming back. Of course, the government, to our understanding, has a whole host of other measures which they've not unraveled as yet. We would hope to see some more on the banking side. Clearly, of course, merging some banks is one way to strengthen balance sheet. At least the optics may look better. But I think, we're looking forward and hopeful for more action on that side, yes.
Vishal, the thing is, your liquidity, as you mentioned there, is a problem. Credit is a problem. Those things together can engender a horrible negative feedback loop because of also the mark-to-market of assets.
That's right. So, we're not shying away from the pain that we have right now. So clearly there are severe challenges. But again, in a surplus liquidity environment with some amount of trust and therefore actual credit flows coming back could be one of the ways to sort of get us out. Now, this is not going to be immediate or even near term. We think it will take some more time before some of this gets flushed out. But at a fundamental level, this is not necessarily an asset bubble where values in the underlying are not around. So you still see portfolio sales and investments coming through. So a fair amount of the distressed asset buyers and investors coming back into the market because some of the values that you can find today are dirt cheap.